This is our fifth video under the capital budgeting principles section, and we now turn our attention to the payback period and the discounted payback period techniques. The payback period is the number of years it will take to recover the initial investment from the net cash inflows from a project. In other words, how long does it take to get our money back? It's calculated by adding the project's net cash inflows that you expect over the life of the project to the initial investment, which is a net cash outflow, until the cumulative net cash flow for the project turns positive. This is a very simple calculation that we can demonstrate with an example. Let's turn back to Project S and Project L that we looked at in the second video and again in the third video. Here's Project S cash flows, and we're going to calculate the payback period, and we're told that the required payback is 3 years. So what I'd like to do is form a third column where the Greek letter sigma here refers to summation in mathematics. I'm going to keep the cumulative net cash flows for the project. We start 10,000 negative. Let's say we're in the hole 10,000. If I add 5,000 to that, I'm going to be 5,000 in the hole. If I add 4,000 negative 5,000, I'm 1,000 in the hole. And then in the next year, we turn positive. We get out of the hole. So the payback occurs between years 2 and 3. And if we want to assume, and let's do so, that the net cash flow in year 3 is spread evenly throughout year 3, then we can interpolate and determine that the payback is 2.33 years. How do I get that fraction? Think about this logically. We need 1,000 to get out of the hole. We expect next year's net cash flow spread evenly through the year to be 3,000. It would take us a third of the year, 1,000 over 3,000, to get the 2.33 years. Since the required payback is 3 years, we would accept Project S. It pays back in less time than what's required. For Project L, here are the cash flows. Again, we form a third column. We keep a cumulative sum. We start 95.50 in the hole. We add 1,000 to that. We're 85.50 in the hole. Add 3,000. We're 55.50 in the hole. After year 3, we're still in the hole. It's not until the final year. We need 1,550 to get out of the hole at the end of year 3. Next year's cash flow is expected to be 6,000. It would take us 1,550 over 6,000. We add that to year 3 when we're still in the hole. It's between 3 and 4. So it would be 3.26 years. And we'd reject Project L because it pays back in a longer time than what's required, because the required payback's 3 years. And that's the decision rule for payback. Simply compare it to the required payback. If the payback period for a project is less than what's required, you accept the project, and vice versa, of course. So since the required paybacks for Project S and L is 3 years, we would accept S and reject L. There are some serious disadvantages to the payback period that should completely discourage its use by financial managers. It ignores time value of money. We treated a cash flow at time 0 in the same way that we treated a cash flow in year 3 and 4. We completely ignored that $1 today is worth more than $1 in year 3 and year 4. We ignored risk. Now, we incorporated risk in the net present value. How? Through the cost of capital. We discounted the future cash flows at a cost of capital that is a risk-adjusted required rate of return. And in the IRR, we compared the IRR to the risk-adjusted required rate of return. So that's how it was incorporated there. But since we're not doing any present value calculations here, we're not correctly incorporating risk into our analysis. It ignores cash flows beyond the payback period. Let me change Project L for a second. Remember, we rejected L because it paid back in, I think, 3.26 years, and the required payback's 3 years. But suppose I added a 5th year here, and the 5th year cash flow is $20 billion. Well, throw the calculations out the window. We know we'd invest $9,550 at time 0 to get $20 billion in year 5, but the payback wouldn't change. It would still be 3.26 years. Any cash flows that are beyond the payback period get ignored. They're left out of the calculation. So we know that's a serious flaw. We know any good technique should incorporate all the cash flows over the life of a project, and this technique does not. The required payback set by a firm, it's subjective. We said it was 3 years, what was required for Project S and L. But that 3 years, there's no theory behind that would lead us to believe that that would be the payback that would discriminate between projects that would add value to the firm and those that would not add value to the firm, that's not going to happen with payback period. So as a result of these criticisms or disadvantages of the payback period, the payback period should not be used because it will not identify those projects that would lead to maximizing shareholder wealth for the firm. Now, are there any advantages to the payback period? Some slight ones. Some say it's an advantage is it's simple to calculate, but so are NPV and IRR with financial calculators and Microsoft Excel, built-in formulas for determining them. So I don't buy that argument. But I will look at it with some projects, particularly if I have a project where technology, the project's in a field where technology is rapidly changing, then I might want a pretty quick payback. I'm not going to rely on that project remaining viable for 5 years to be able to earn the NPV that makes it positive. Or sometimes when companies consider making investments in developing countries, and there I've done some consulting work in, where the countries have an unstable government, and the very poor country that's looking for investments in infrastructure, such as investments in power plants, water treatment facility units, roads and highways, telecommunications networks. Well, the paybacks on these periods can be quite long. You don't pay back a power plant in 2 or 3 years. But if the government is unstable, a company would likely not make such an investment if they believe that project could be expropriated by some new government that comes in through a coup or something. So it could be useful information in that type of situation. But I would not rely on the payback period as the primary criterion for evaluating a project. Let's now turn to the discounted payback period, which uses the present value of cash flows to determine the discounted payback. As a result, this method takes into account the time value of money and also takes into account risk. How? Well, we're going to use the cost of capital to compute the present value of the cash flows. And of course, the cost of capital incorporates risk. So let's turn to project S. We'll calculate the discounted payback for S, and then we'll look at L. Recall that from our second video that both projects have a 10% cost of capital. So I'm going to estimate the present value of the cash flows. The 10,000 initial investment is already a present value. It's at time 0. Take the 5,000, take the present value of it for 1 year. So take 5,000 and divide by 1.10 to the 1 power. Take 4,000, divide by 1.10 squared. Take 3,000, divide by 1.10 cubed, and so forth. And now we'll do the payback on the present value of the cash flows. So I'm taking the sum of the present value of cash flows. We start 10,000 in the hole. When we add 45, we are still in the hole. We keep going. And then between years 2 and 3, we get out of the hole. I'm going to go ahead and continue and put the 4th year in here. I'll discuss that in a moment. But we can see that the discounted payback occurs between years 2 and 3. If we assume that the present value of year 3 cash flows are spread evenly during the year, we need 2149 to get out of the hole, and we expect 2254. It's going to take almost the entire year, right? It's going to take 2.95 years. Since the required discounted payback is still 3 years, we would barely accept this project. But I know this project should be accepted. Why? Because of this number right here. Remember that number from before? If you go back to the second video, 788 is the net present value for this project. That's exactly what we're doing in this column, both columns here. We're taking the initial investment and we're adding the present value of the net cash flows. That's what you do in an NPV calculation. If we take this column and sum it, we'll get 788. And that's what I'm just doing step by step in this last column. So if you go all the way through to the end and include the present value of all the cash flows, you should wind up with a net present value. And the technique is kind of useful then. It kind of shows me how long the project needs to last to reach that NPV. Let's do it for project L. Again, we're going to take the present value of all those cash flows. The 9550 is already a present value. Take the 1000 divided by 1.10 to the 1 power. The 3000 divided by 1.10 squared, and so forth to get the present values of the cash flows. And then we do the summation of the present value of the cash flows. We're 9550 in the hole. and we keep going, and actually it takes all the way to the end until we get out of the hole between years 3 and 4. If we assume that the 4,098 present value was spread evenly throughout the year, and we need 3156 to get out of the hole, it's going to be 3.77 years. Now notice, based on the required discounted payback of 3 years, we would reject this project. We know that's a bad decision. We know 942 is the net present value. Go back to second video, see that was the net present value that we got for the project, as demonstrated by the calculations here. So we can see here that the required payback period, if you're going to use the method and make your decision based on the required discounted payback, it's a flawed method, okay? If I'm going to hold out the 3-year required payback as the screening under this method, it's a flawed technique. As long as if I were to change the decision criteria and say if the required payback exists, as long as it turns positive, it's an acceptable project, then the technique it's basically just a net present value calculation, just breaking down the net present value calculation year by year. Okay? But the textbooks, I've never seen a textbook except the one that my co-author and I wrote that kind of show that. Anyways. Well, let's finish then with evaluating the payback period, discounted payback period. You'll recall that we've identified some desirable criteria for screening projects that techniques should have. So let's look at the payback period, discounted payback period. Do they incorporate net cash flows? Yes, we're not using net income like the accounting rate of return method would use in your accounting textbook. But that's about it. Does it include all the estimated cash flows in the life of the project? No. For the payback period, definitely not. For the discounted payback period, if you're going to just compare it to the required discounted payback, then you stop once you've hit the payback. Does it take into account time value money? The payback period, no. The discounted payback period, yes. We did take present values of net cash flows. Does it incorporate risk? Payback period, no. Discounted payback period, yes, because we use a cost of capital. Does it identify projects that maximize shareholder wealth? Payback period, definitely not. Discounted payback period, no, if you're going to use the required discounted payback period. But yes, if you use the criteria that as long as the discounted payback exists, then the NPV is positive and you would accept the project. But I'm going to keep it as a no here if we follow the kind of the standard textbook way the discounted payback period is used. Okay, this ends our discussion on capital